You have long been an advocate of higher rates to head off inflation, which of course we are not seeing. So does that make you feel uncomfortable, like maybe there's something you might be missing?
So firstly, monetary policy is still accommodative. So the gradual path of normalization is really a gradual path. And my argument of why we want to stay on that gradual path is because we are in a more normal economy. Inflation is not yet at 2%, but what we've learned is that we have to move policy a little bit before we get to the goals, or else we're going to be behind or potentially behind. So there's some risk that if we wait too long, we could find ourselves in a bad spot. So again, I wouldn't say I'm an advocate of higher rates. I am an advocate of keeping on this gradual normalization path where we're basically taking away some of the accommodation that we needed to put in for the Great Recession and its aftermath.
And you think, therefore, that the risk of higher inflation is greater than the risk of higher rates having a damping effect on the economy?
Well, there's a number of risks out there, right? So again, I think the underlying momentum of the economy on the real side is very good. We have very strong labor markets, and we've seen that over time. It's not just a one-off report. Steadily improving labor markets. We've also seen that growth has been maintained at a little above 2%. Or so, and I think that's very important because we have had a lot of shocks to this economy, and yet the economy has proven to be pretty resilient. Again, you're right, inflation has not yet gone up to our 2% goal. We've had a couple of weak inflation reports lately, but you can point to some one-off factors in terms of prescription drug plan prices and cell phone data plans. So again, I do expect inflation to remain below 2% over the next couple of months or so and near term, and then eventually rise up to our 2% goal. That's my modal forecast, and I think consistent with that, we want to have accommodation being gradually removed from the economy.
Is there anything that would cause you, any data change that would cause you to change your view that accommodation should be removed?
So one of the key factors in the inflation forecast, of course, is inflation expectations. So far, I think they've been very stable, and that's a very important factor in the inflation forecast.
But your own Cleveland Fed expectations indexes have been moving down the last couple of months.
Well, they've moved down, but the kinds of moving down isn't significant. I mean, I would be worried if the low inflation numbers were telling us that aggregate demand was really falling off, and that's the reason prices were coming down, and therefore inflation expectations would be unanchored. I don't see that in the data. I don't project that is what's happening. But that would be the factor that would be significant in my view, that there's a bigger problem and we're not going to be able to make our inflation goal over time.
What do CEOs in your district tell you about their pricing power these days?
So most of the CEOs that I talk to in businesses and even labor market people, they're telling me that they are increasing wages. They are not necessarily increasing prices yet because their margins are still constrained, but in terms of the wage part of the equation, that wages are moving up, and I expect those eventually to feed into the aggregate numbers. We've seen some slow wage growth, relatively slow, but we have seen a pickup. And a very important factor in that wage growth is the productivity growth we've seen, which is quite low. So again, there are some firms that have been able to increase prices which they haven't been able to do for quite a long time, and wages do seem to be moving up, albeit gradually.
As you look at what your forecasts are going to be, particularly for inflation and growth, Wall Street is a long way from where you are. And they would argue, the traders would argue, that they've been right and you've been wrong. How do you counter that? What do you say to them?
Well, we have been doing this gradual reduction in accommodation for quite some time. That's been our strategy. And I think that's still what the strategy should be, given where the outlook is. Their path for interest rates may differ from our path, but I think we've been very consistent on this strategy of looking at the economy, looking at our median run outlook, moving a little bit preemptively in terms of we don't want to wait until both of our goals are met. We've learned over time that that's not a good strategy. And we have been gradually moving. And I think the gradual part is very important. We are well below what a Taylor rule or other kinds of rules might tell us where we'd be at this point. So in that sense, we've been patient. We have been gradual. And I think it's actually done pretty well for the economy.
Do you think that the pace has been appropriate? Do you see any reason it would pick up? There's been some concern, financial stability concerns expressed, prices of assets elevated. Do you see any reason that you would want to move faster.
Well, I think we always want to be concerned about financial stability. I mean, that's certainly a lesson that we've learned. And these issues loom large, especially when interest rates have been as low as they have been for as long as they have been. Right now, you're right, there's some pricing in the equity markets that look different than historical values. I think part of that's generated by the earnings that firms have been able to generate, but also because the interest rates are low. So we're certainly focused on that. Right now, I don't think that's a significant risk, but I'm certainly taking that into account. And again, that's another factor that feeds into my view that a gradual reduction in accommodations is appropriate for where the economy is now.
Is there a role, in your view, for getting rates higher so that you have ammunition the next time we have a downturn?
You know, I never really understood that argument. I think we should be setting policy to aim at our median run and longer run targets, target for inflation, and also goal of maximum employment. And we should set the level of interest rates appropriate to that. So I wouldn't want to do harm today because of some anticipation of having to use our interest rate in the future. We want to basically set our interest rate path to be consistent for hitting our longer run goals.
Do you see any reason that you won't proceed with announcing the start of balance sheet reduction in September?
Well, I think we always go into every meeting and we look at what's happening in the moment around that. But I certainly am in favor of starting that reduction, starting on the plan that we've actually communicated to the public soon.
Does the Cleveland Fed have any estimation for what kind of reaction we'll see with yields? Might we get something of a de facto tightening?
Well, I mean, I do believe that there will be some impact in financial markets, but, you know, it's such a gradual plan, if you look at the specifics of it, that I don't anticipate that we're going to see a huge reaction that would last for a long time in terms of that. But, you know, it's such a gradual reduction that I think we have time to assess that and to get estimates of that as we go forward.
When you talk to Fed officials about balance sheet reduction, they always emphasize, well, we've never done this before. We don't exactly know what the effects might be. So is there anything in that you worry about, something untoward, unintended that might come out of it?
Well, again, by design, it was designed so that it could be very gradual and very predictable. And the intention there was twofold. One, we've known that, you know, one of the effects of the asset purchases is a signaling effect. Does it signal something about policy in the future? We've designed the reduction to be one that we really aren't signaling anything except that we want to reduce the balance sheet, as we've told the public for many years that our aim would be to do when the economy got more normal. And so this is a very gradual reduction. So I'm not anticipating anything untoward happening in the financial markets, but again, we always are going to be nimble and look at what's happening in the markets and react appropriately.
Asset prices went up when you expanded the balance sheet. That was the point.
Right.
Why wouldn't they go down when you reduce
So
it?
remember, part of the impact is because financial markets were disrupted. If you remember the first QE1 program, where we bought assets, there was an arbitrage going in the markets. The markets were not functioning well. You'd expect to have bigger effects, and all the studies suggested that QE1 had the largest effects because of the market functioning issues. Over time, the effects diminished because the economy is healthy, things are going well, and so you'd expect to have a decline in that. There'll probably be some reaction in the long rate, but I think it'll be swamped by other things that are going to affect financial markets. I don't believe our plan to reduce the balance sheet is going to be a major factor.
Last question on that. The ultimate size of the balance sheet is something you haven't communicated to the markets because you don't necessarily know, and that will depend in part on the monetary policy regime that you end up using. Do you have a favorite yet? Would you like to go back to just targeting Fed funds? Do you want to stay with the IOER and repo system that we have
So I
now?
haven't come to a definitive determination in my own mind. I see pros and cons of each of the methodologies. I mean, it would be nice to go back to what we know, what we've used over time, but a larger balance sheet does allow for much simpler implementation practice. You don't have to estimate a downward sloping, reserve functioning. And so I'm probably leaning to having a slightly larger balance sheet, but nonetheless, it'll be smaller than it is, considerably smaller than what it is today.
Is there anything you're taking away from this year's Jackson Hole Symposium?
Well, I think it's been a fascinating couple of days. I think the papers are very well timed to some of the issues that we've been struggling with because there really isn't enough work being done on them. And I think now bringing together this group of very, very distinguished academics and policymakers is very useful. We talked about productivity growth. We've talked about gains from trade that aren't sort of distributed evenly across various constituents, and what do you do about that? How can you handle that? And so I think those issues are very important. Not that monetary policy can affect them, but we have to understand the environment in which we're acting, and so I found it very useful so far.